Paragraph 13, deductible temporary difference. Now from the name you have to guess what could be this item. Will it give rise to deferred tax asset or deferred tax liability? Asset, because these are those temporary differences which are deductible from tax liability in future. Deductible. They will be deductible from taxable income in future. So if it is going to be deductible in future, it will save taxes for you. So this give rise to deferred tax asset. These are those temporary differences that will result in amount that are deductible in determining taxable profit of future period when the carrying amount of the asset or liability is recovered or settled. This results in lower taxable profit in future. Now see this fellow, he is crying right now. Why? And he is laughing. Pay now. Because right now these differences results into more tax liability. Let us say the law of the country says that GST will be allowed as a deduction. What is GST? Goods and service tax. Only on payment basis. Only on payment basis. So in the books of account you can create a provision for GST. So in the books, provision for GST is created, a liability is created. But this liability was not paid. It will be allowed as a deduction in the year in which you will pay the tax. Okay. So once you pay the tax, this will result in lower taxable profit in future. Pay more tax now and save later. Pay now, save later. Such difference will give rise to deductible temporary difference. So there are two possible situations when deductible temporary difference will arise. For example, asset side. When carrying amount of the asset is less than its tax base. For example, you purchased a computer and you think its useful life is only 2 years. So you want to write off 50% in the first year. So cost of the computer is 1 lakh minus 50%. Carrying amount is 50,000. But will income tax allow you 50% deduction depreciation? Kitna hai? How much is that? 40%. So your tax base will be 1 lakh minus 40%, 60,000. So this is an example where the carrying amount of the asset is less than tax base. So in future you will get 60,000 deduction under tax law, but you will only recover 50,000 rupees in books of account. So more deduction in future will be allowed when you recover the carrying amount of the asset. So this will give rise to DTD. Liability side. Many examples are there in liability side. Carrying amount of liability is greater than tax base. For example, provision for gratuity. Carrying amount in the books is 10 lakh. 1 million. But tax base is 0. Because it will be allowed in future on payment basis. Provision for bonus. Carrying amount 1 lakh. Tax base 0. Like this. So most of the provisions which are allowed for deduction on payment basis, all these fall under deductible temporary difference. Deductible temporary difference give rise to what is called deferred tax. Deductible temporary difference will give rise to deferred tax. Deferred tax assets are the amount of income tax recoverable in future period in respect of deductible temporary difference. Okay. Is it written in your book also? Yes. This will be deductible temporary difference. But this standard also allows you to create DTA for two more items. Deductible temporary difference, you will create DTA. You will also create DTA for carry forward of unused tax loss or carry forward of unused tax credit. So that means what you can say, carry forward of losses. In some country they call it carry forward of unused tax loss. In some country they call it carry forward of unused tax credit. In some country, suppose you have a loss here, they allow you to set off for future income. But in some country they also allow you to set off against past income also. That is backward adjustment. Okay. But that is, I think, very few countries. When I was doing CPA exam, which is USA based exam, so there this adjustment I had learned, that you can set off the loss against previous year also. You can carry forward, you can carry backward. First few days I could not digest it only. Then after some research I found that no, this is okay. This is also allowed. So even that can be called as unused tax loss or tax credit. But in some countries like India, you can only move forward. Because if we allow backward, then our intelligent people who are already so intelligent as far as tax laws are concerned, Indians are most creative when it comes to income tax adjustment. Okay, most creative entities. All their creativity in India has gone into income tax only. Otherwise, we would have surpassed Google, Facebook, Twitter, WhatsApp, and all other big entities if this Income Tax Act was not there in India. Is it right? Okay, come to the topic. Point number 14. Under that, we will consider two situations. Now I'm going to test your knowledge, what you have learnt. Downward revaluation of asset without a corresponding adjustment to its tax base will result into temporary difference. This adjustment you keep in mind, because when you solve problems of consolidation, they will say that A Limited acquired B Limited on the date of acquisition. Some of the property, plant, equipment was written down by so much of amount. Also, it will give rise to taxable temporary or deductible temporary difference. While preparing final accounts, give the effect of tax difference also. Then this paragraph will be useful. Revaluation, if nothing is given, it will give rise to tax consequence. And if you have revalued the asset downward, book value is reduced, but tax base is not reduced. So tax base becomes higher, carrying amount becomes lower, and this will give rise to deferred tax asset because it will have tax saving in future. So deferred tax will be recognized. Now you answer. Suppose there is a retirement benefit for employees. We will make provision for retirement benefits. But income tax authorities allow provision for retirement benefit only on payment to employees. So in the books of account, a liability is created, but its tax base is zero. Carrying amount of liability is more than tax base. So this will give rise to a deductible temporary difference. A DTA will be created. Okay. So now you solve this example printed below. Question number 24. A company has made provision for warranty cost of rupees 10,000 in its accounts. Tax laws do not permit deduction until the company actually pays the claim. Tax rate is 30%. Compute DTA or DTL. In the exam, they will say compute DTA or DTL. Then you have to first see what is the carrying amount of the liability, 10,000. What is its tax base? Tax base is 0. Why? Because carrying amount minus amount that will be deductible for tax purpose in future. So whenever you pay, 10,000 will be allowed. 10,000 minus 10,000, write down 0. Therefore DTD 10,000. Therefore DTA 3,000. Okay, right. Then steps to calculate deferred tax asset or deferred tax liability. So after this basic understanding, now you can solve many basic questions now. Okay, that means fundamentally you have learned this chapter. After that only special issues will arise. Find out the carrying amount of asset and liability by applying respective Ind AS, by applying respective IFRS. Okay, by applying respective IFRS. Then determine tax base of asset and liability. That you have learned. Tax base of asset. Check whether future economic benefits are taxable or not taxable. If taxable, is it related to expense or income? In case of liability, whether it is related to expense or whether it is related to income received in advance. And the third is, it may not have any carrying amount, but it may have tax base. So you will today practice all these paragraphs again. Find out the temporary difference. If the two figure step 1 and 2 are not matching, it means there is a temporary difference. Then check whether this temporary difference will give rise to TTD or DTD. If it is TTD, DTL will be created. If it is DTD, DTA will be created by multiplying temporary difference into tax rate that have been enacted or substantively enacted by the end of the reporting period. So now you make a small summary in your notes, paragraphs, I think 16. Check. If situation 1 is carrying amount of the asset is greater than, carrying amount of the asset is greater than tax base, is greater than tax base, then it is called taxable temporary difference. Taxable temporary difference. Okay. Taxable temporary difference. And it will give rise to DTL. Will give rise to DTL. Second point, right? CA less than TB. CA less than TB will be DTD. DTD, then write DTA. Then write down CA greater than TB. CA greater than TB. DTD give rise to DTA. CA less than carrying amount of liability, less than tax base, less than tax base. TTD, TTD. Okay, this fourth situation is rare. So I have given you homework to find out. Ask your office boss also if he can give a reply. In which provision of income tax the carrying amount of liability, it has to be a liability item, not asset item. is less than the tax base of the liability. Okay, now we'll solve one question. A Limited has the following liabilities in the statement of financial position. Serial number, particular rupees. So what I have done, I have written the 3 columns in your book. You have to complete the other columns. Advance, loan payable, advance income, which is non-taxable in future. Income received in advance, which is taxable in future. Creditor, bonus payable, outstanding interest payment to nationalized bank, rent payable, printing expenses payable, gratuity provision. Then tax rate is 30%. Calculate the tax base and deferred tax asset or liability. Is it right? So one I will show you how to do it, and then you will try the other one. Open book exam. Try, look at the formula if you want. One good thing is that these are all liabilities item. So only 2 formula you have to apply. First, for example, loan payable. Carrying amount is 10,000. Now, if you think it does not have a tax consequence, no tax consequence, then tax base, this answer column is tax base. This tax base is formula and this tax base in rupees. You write tax base rupees. Then if it is 10,000, the difference, this column is difference, either DTD or TTD. Most of this will be DTD only. And then you compute DTA at 30%, 0. Okay, one more chance. Income received in advance, minus, not minus, which is non-taxable in future. This is not a minus sign, it is an explanation that it is a non-taxable income in future. Okay. What is the formula you have learned for income received in advance? Carrying amount minus amount not taxable in future. Carrying amount minus amount not taxable in future. Carrying amount is 5 lakh, amount not taxable in future is also 5 lakh. So 5 lakh minus 5 lakh is 0. Now you compare column number 3 with column number 5. 5 lakh versus 0. So difference is 5 lakh. It means it might have already taxed on cash basis. Okay. So it will give rise to difference. So here DTA will be 1,50,000. Say yes. Okay, now you try C, D, E, F, G, H, I. I will give you 1 minute to try. I'll come in 1 minute and I will check how many of you have done correctly all the remaining answer. Open book exam. Is it over? Okay, now we'll check the answer. Third answer is carrying amount minus amount not taxable in future. 3 lakh minus 0, 3 lakh. So since 3 lakh and 3 lakh are matching, this two column will become 0 and 0. Creditor, no tax consequence. You can just write down no tax consequence. 4 lakh, 0, 0. Bonus payable. We will assume that bonus will be payable on cash basis. Okay. Section 43 be read down applicable. Section 43B means allowed on payment basis. So carrying amount minus amount deductible in future period. 1 lakh minus 1 lakh. 0. Difference is 1 lakh, DTA 30,000. Outstanding interest payment to nationalized bank. Again write down section 43B applicable. If section 43B is applicable, carrying amount minus amount deductible in future period. So interest is allowed on payment basis. 50,000 minus 50,000. 50,000 will be allowed in future. 0. Difference 50,000, DTA 15,000. Rent payable. This has no tax consequence. Write down no tax consequence. If there is no tax consequence, tax base is same as carrying amount. 0, 0. Printing expenses payable. No tax consequence. Carrying amount and tax base are equal. 1,60,000, 0, 0. Gratuity provision will have a tax consequence. Carrying amount minus amount deductible in future period. So 20 lakh minus 20 lakh, 0, 20 lakh, 6 lakh. So who got it fully right? Acha, you were not aware whether this will be 43B or not. Anyway, now you have got reasonably good idea how to solve such problems. This will draw the table in the exam if there are many items. And then we will now solve question number next. A Limited has debtor of 10,000, loss allowance 1,500. Calculate DT assuming tax laws do not allow loss allowance. Tax rate is 30%. Solve. So what is carrying amount? Carrying amount in case of receivable is your gross amount minus loss allowance. That is 8,500. But tax base will be 10,000. Under the tax law, when the actual bad debt will happen, that time it is allowed as deduction. So therefore it will give rise to deductible temporary difference 1,500, and therefore it will give rise to DTA equal to 450. Is right 450? Okay. Now next is asset carried at fair value. Actually this paragraph by mistake is a repetition. It was there earlier also as a one question number 8. So we'll just quickly go through it, okay? In the books of account, assets can be carried at fair value. One has to see what is the tax implication. If tax laws also allowed fair valuation, then there will be no difference. But if the tax laws do not allow fair valuation, then there will be taxable or deductible difference depending upon whether the fair valuation has been done on the upward side or on the downward side. Okay. So see first paragraph below that. Tax jurisdiction permit fair valuation. If tax jurisdiction permit fair valuation, tax base is also affected. Therefore, no taxable temporary difference and consequently no future tax liability. But tax jurisdiction will not permit fair valuation, then in that case the tax base is not adjusted on fair valuation of asset. And if the fair value of the asset is carried above the tax base, this will give rise to taxable temporary difference, and therefore you'll have to create a deferred tax liability. Now solve the next question, where we are going to make an adjustment in the carrying amount of the asset, and you have to answer what will be its tax implication, deferred tax implication. Okay, a very important question. A Limited purchased a plant on 1,416 for rupees 10 lakh. This question will be required for consolidation problem. Okay, where they will give you A Limited had acquired B Limited, its plant was 10 lakh rupees, like this. Depreciation rate is 12% per annum on WDV basis. On 31st March 18, the recoverable amount of the plant is rupees 4 lakh. So what I need to do, I need to check whether there is an impairment loss or not, by first finding out what will be carrying amount after 2 years in the books, that compare it with 4 lakh. The difference is impairment loss, if any. But impairment loss is not allowed for deduction under the income tax law. So then I will compare the carrying amount after providing impairment loss with the tax base. The difference will be your DT or DTL. Let us write down some discussion. First write down carrying amount as on 31st March 18. Carrying amount as on 31st March 18. So you can write in one line also, 10 lakh minus 12% minus 12%. 2 times minus 12%. So how much is that? So write down carrying amount before impairment loss. Check the answer. Is it 774 400? In bracket write before impairment loss. Before impairment loss. Have you reached 774 400? But the recoverable amount is 4 lakh. So below that write down impairment loss equal to 7,74,400 minus 4 lakh. Minus 4 lakh. And therefore impairment loss is 3,74,400. 3,74,400. Okay. Therefore carrying amount after impairment loss. Carrying amount after impairment loss is 4 lakh. Now this is my carrying amount now. I need to compare it with tax base. So below that write down next line, tax base as on 31st March 2018. Tax base as on 31st March 2018. Then write down what is the cost, 10 lakh minus 18% minus 18%. 2 times, because 2 years have expired. So check the answer. If you write in shortcut, it is okay. 10 lakh minus 18% minus 18%. Are you getting 672? 400. Carrying amount is less. Tax base is more. Therefore, Now write down calculation of DTD and DTA. Calculation of DTD and DTA. Now write down tax base 670 to 400. 670 to 400. Below that write B, less carrying amount 4 lakh. Carrying amount 4 lakh. C, DTD 270 to 400. 270 to 400. Therefore DTA at the rate of 30%, how much you are getting? 81720. Right. Now we'll play rapid fire round. Okay. Rapid fire round. Whether following items will give rise to DTA or DTL. So now you have to think fast. 5 seconds per question will allow. 5 seconds starts now. Interest revenue is received in arrear is included in accounting profit on a time apportionment basis, but is included in taxable profit on a cash basis. Just you have to answer whether it will give rise to DTA or DTL. For accounting purpose, it is recognized on time proportion basis, accrual basis. For tax purpose, it will be recognized on cash basis. Time over. DTL, write down there. Because you are postponing your tax liability. Okay. If you compare the carrying amount, it will be equal to the amount accrued, but tax base is 0. So DTL. Okay, try this one. You'll get the hang of it. Your answer will become faster as we'll move ahead. Revenue from sale of goods is included in accounting profit when goods are delivered, but is included in taxable profit when cash is collected. Both questions are same. That was interest revenue. This is revenue from sale of goods. So items which are taxed on cash basis, revenue item which are taxed on cash basis, can we simply conclude they will give rise to DTL? Okay, try one more. Development cost have been capitalized and will be amortized to the statement of profit and loss, but were deducted in determining taxable profit in the period in which they were occurred. So development cost have been capitalized. So it has some positive carrying amount, but they have already been written off for tax purpose. So tax base is how much? 0. Okay. Amount that will be deductible in future is 0. So carrying amount is positive, tax base is 0. So difference will be DTL. You will not get any tax benefit in future. Financial assets are carried at fair value which exceeds cost, but no equivalent adjustment is made for tax purpose. Answer DTL. Fair value is more, tax base is lower. DTL. An entity revalues PPE under revaluation model in IAS 16, but no equivalent adjustment is made for tax purpose. Same problem. Revalued means always nothing is given upward. So DTL. The carrying amount of the asset is increased to fair value in a business combination, but no equivalent adjustment is made for tax purpose. Same question. Now this question will be required for business combination problems. Next question. accumulated depreciation of an asset in financial statement is greater than the cumulative depreciation allowed up to the end of the reporting period for tax purpose. No, wait. Think and answer. Every answer is not DTL. Huh? DTA. Accumulated depreciation is greater than depreciation allowed for tax purpose. DTA. Sure. Final. Lock. DTA. Okay, now the answer will be random. It may be DTA or DTL. Try next one. Net realizable value of an item of inventory or the recoverable amount of an item of PPE is less than previous carrying amount. So we have reduced the carrying amount because NRV has gone down, recoverable amount has gone down. Then therefore reduces the carrying amount of the asset, but that reduction is ignored for tax purpose until the asset is sold. DTA. So carrying amount has gone down. Tax base is still at a higher level. So this will give rise to DTA. Okay, one more. Think and answer. I'll wait 10 seconds this time. See, your speed has increased. You didn't realize only. First question you took 20 seconds and now you are answering in 3 to 4 seconds. The government grant which is included in statement of financial position as deferred income will not be taxable in future period. See, government grant will be slowly transferred to income statement as because it's a deferred income. So next year you will transfer some amount to income P&L account, but it will not be taxable in future period. But in future you don't have to pay tax on this item. So will this give rise to more tax liability in future or tax saving in future, or no tax consequence? Tax saving, you will show it as an income, but it will not appear for income tax purpose. Yes, everything is future. DTA means future, DTL means future. It will have no tax liability in future, but it will appear as an income in the P&L account. So DTA. Financial assets are carried at fair value, which is less than cost. Now, it may be some investment item which is measured at FVTPL, okay? And you have reduced its fair value, carrying amount reduces, but no adjustment for tax purpose. Yes, DTA or DTL? DTA, very good. One last chance. Unrealized profit resulting from intra-group transactions are eliminated from carrying amount of the asset. Again, you tick mark this adjustment I will require for consolidation problem very soon. Okay. So that time they will say parent has sold goods to subsidiary. So we have to eliminate the unrealized profit. But also it will have tax consequence for consolidation purpose. Are eliminated from carrying amount of assets such as inventory or property, plant or equipment, but no equivalent adjustment is made for tax purpose. DTA, because income tax will allow you the full deduction. Only for accounting purpose we will eliminate the unrealized profit. But for tax purpose, the entire value of the inventory appearing in the books of buyer will be allowed as a deduction. So DTA. So that was a rapid fire round over. Now come to slow questions. A Limited purchased a machine for rupees 10 lakh. Depreciation rate is 25%. This question you solve in the notebook because this place is not sufficient. As per tax law, depreciation rate is 40% SLM. PBDT is 30 lakh each year. What is PBDT? Profit before depreciation and tax. Prepare SOPL for 4 years. Prepare SOPL for 4 years. Now for calculating or preparing SOPL, I require following number. I require PBDT given. I require depreciation as per books of account. That also I can calculate easily. And then I require tax consequence. So I have to compute current tax, deferred tax. Have I given you current tax figure? Tax rate figure? Just write down in that question, tax rate is 30%. Tax rate is 30%. I think tax rate is not printed. If not printed, then write down tax rate is 30%. Start solving. First, what you will do, quickly you will prepare depreciation as per accounts. Step 1, write depreciation as per accounts. Now you have to compute year by year because SOPL you have to prepare for 4 years. So I will give you the format on the screen, serial number, particular, year 1, 2, 3, 4. Opening balance, depreciation at 25% SLM means every year 2,50,000 and closing balance. Write neatly because when you revise it becomes easy when you write neatly. For those answers you are writing in notebook, give reference of your notebook number and page number. So write down. Very easy without calculator. 10 lakh, 2,50,000, 7,50,000. Next year 7,50,000, 2,50,000, 5 lakh. Next year 5 lakh, 2,50,000, 2,50,000, 2,50,000, 2,50,000, 0. So this problem will give you a broader view now how the system works for many years. Okay, now for income tax purpose, depreciation rate is 40% SLM. 40% SLM means first and second year you will deduct 40%, but then in the third year you can only deduct whatever is remaining, and the last year no deduction. Okay, whatever is given accordingly solve. So write down step 2. Step 2, depreciation as per tax laws. If nothing is given, then for tax purpose you assume WDV, okay? If not given, but it is given in this problem. Solve. 10 lakh, 4 lakh, 6 lakh. Second year 6 lakh, 4 lakh, 2 lakh. Third year 2 lakh, you can't write depreciation 4 lakh. 2 lakh only. And then 0. Fourth year 0, 0, 0. Now write down step 3, current tax. Current tax. Current tax. Under current tax, right hand side 4 columns. Year 1, year 2, year 3, year 4. Write A, PBDT. PBDT. Solve. I have given you the format. Solve. PBDT 30 lakh in all the 4 years right now. PBDT 30 lakh in all the 4 years. While calculating current tax, take depreciation as per tax laws. Tax laws. Step 2. 4 lakh, 4 lakh, 2 lakh and 0. Right? Point C will give you taxable income. Taxable income. Taxable income. Taxable income 26, 26, 28, 30. Then write down tax, current tax at the rate of 30%. Current tax at the rate of 30%, 7,80,000, 7,80,000, 8,40,000 and 9 lakh. Okay. Now dear student, our next step would be deferred tax. Deferred tax. Again you draw the format year 1, year 2, year 3, year 4. Year 1, year 2, year 3, year 4. Then you have to compare carrying amount with tax base. Is it right? So point number A, write down carrying amount in bracket step 1. Go to step 1. 7,50,000, 5 lakh, 2,50,000, 0. B. Tax base step 2. Tax base step 2. 6 lakh, 2 lakh, 0, 0. Then write down point C. In all the 4 years, at least in all the 3 years, we can say the carrying amount is more than the tax base. So in all the 3 years, we have a taxable temporary difference, correct? So taxable temporary difference A minus B, 1,50,000, 3 lakh, 2,50,000, 0. And then write down D, tax rate, 30%, 30%, 30%, 30%. So in all the 4 years, we will have DTL, 45,000, 90,000, 75,000, 0. Now this DTL will go to SOFP. Then how much deferred tax will be recognized in penal account? Write down one more line, F. Amount transferred to penal account. This is SOFP figure, point number E. Here the students can make a mistake. They may just put this number in the penal account also. First year it is okay, but not for the remaining 3 years. First year we will pass an entry, debit penal account, credit deferred tax liability. So debit to penal account means it is treated as tax expense. Now my balance has increased from 45,000 to 90,000. So how I will pass the entry so that my balance of liability increases from 45 to 90,000? I will pass the entry, same entry, P&L account debit to deferred tax liability. Okay. And then my balance of DTL has reduced from 90 to 75. So this time I will pass a reverse entry, DTL account debit to P&L account, credit to P&L account. Last year from 75,000 to 0. So that is why it is called temporary difference, because the difference will be only temporary. It will get reversed in future. Entry in the 4th year, DTL account debit to P&L account. Now while preparing the SOPL, these two you will add to current tax and these two you will deduct from current tax, so that will get the total tax expense. Now the last step, write down SOPL little fast, come on. Year 1, year 2, year 3, year 4. So this 3-line problem consumed your one full page. Yes or no? Write one question below, 33 number as homework, 32 number, which has answer also printed. Can you see one small question with answer? Financial accounting, tax accounting, calculation of DTL. So only you will go home and read it, check the answer. Is it okay or not? Start. Step 5, SOPL. SOPL, how will you prepare? PBDT, this is my starting point because other data is not available. So my starting point is PBDT, 30 lakh. Point B, less depreciation as per books. Depreciation as per books. 2,50,000 4 times. Point C, PBT A minus B, 27,50,000 4 times. PBT 27,50,000 4 times. Point D, less tax expense. Under that 2 points we'll write separately. 1, current tax. Current tax. Current tax, write down step number 3. Go to step 3, copy. Check, is it 7,80,000? 7,80,000, 8,40,000, 9 lakh. Below that write 2, deferred tax. Step 4 write down. Step 4. First 2 year debit to P&L account. Add 45,000, 45,000. Last 2 year credit to P&L account. In bracket write 15,000, 75,000. So total D write down, total D. How much is total D? 8 lakh. Now see the beauty of IAS 12. In all the year, your tax expense total is exactly equal, and it is exactly equal to 30% of PBT figure. Can you notice that? 30% of PBT figure. So that is why the standard is there, so that if your PBTs are equal, your PAT should also be equal, almost equal. It should not vary too much. So it will be 19,25,000. If there is no change in tax rate, if there is no different types of income on which different rates are applicable, then normally how you will cross check your answer? 2 things will check, that this total tax expense should be 30% of this number. Just check 30% of 27,50,000, and this figure should be 70% of that figure. Is it right? In all the years, is it 70%? Yes. Come to one little complicated question. Question number 31. Following information is given for 3 years. Purchase of fixed asset on 1,416, rupees 10 lakh. Keep a control on this movement of this asset. This fixed asset purchased on 1,416, 50% of these were sold on 1,417. So first year you provide depreciation on 10 lakh. But second year you provide depreciation on only half of the asset. Okay. And at what amount it was sold? 7 lakh. So one more thing you have to do, you have to calculate the profit on sale. You have to also calculate the profit on sale at the time of sale by comparing 7 lakh with the carrying amount of 50% of the asset which was sold. Okay, so that will, they are trying to check your knowledge of other standard like IAS 16 also here. Then purchase of fixed asset on 1/4/17, one more purchase for 12 lakh. It means in year 2 I have two assets to be depreciated. This I will call asset number A, asset number B. 100% of these assets were sold on 1/4/18 for 29 lakh. So in second year you will sell this B fully. And again you have to calculate profit or loss on sale in the books of accounts. But depreciation will be charged in the second year on asset A on 50%, on asset B 100%. Which means asset A still goes to the third year also. In third year, one more purchase. This I will call asset number C. Third year, no major action, only one sale, one purchase. And on this you will provide depreciation for full year. And then you have brought forward asset A also to the third year 50%. You have to see what is its carrying amount at the beginning of third year, and that also you depreciate. To make your life more miserable, method of depreciation is WDV. Okay. 10% WDV for accounts, 25% WDV for income tax. Okay. Tax rate is 30%. Provide profit before depreciation, tax, and profit or loss on sale of fixed asset is 40 lakh each year. So this is profit before providing depreciation, profit also before calculating the gain or loss on sale of fixed asset. Before these two adjustment, this is the profit. Prepare statement of profit and loss. Okay. Now right here, for tax purpose, assume block of asset concept. Assume block of asset concept. Block of asset concept means all asset which are subject to same rate of depreciation will come under the same block. When you buy, add. When you sell, deduct the sale value. Okay. And then you compute the depreciation by doing plus and minus. Then whatever balance comes on that, you compute the depreciation. Right. So first what I need to do, again like previous question, I need to do 4 working notes before I prepare the SOPL. Which 4 working notes I will complete before preparing SOPL? I need to find out the depreciation as well as in this question profit or loss on sale. Second thing, I have to find out the tax depreciation. Third, I need to find out the current tax. Fourth, deferred tax. And fifth, SOPL. So write down. First, I will show you how to prepare property, plant, equipment. Either you do it in the form of a ledger account or in the form of a statement. What do you prefer? Account? Right. Account is easy. Buy, debit, sell, credit. Depreciation, credit side. And if there is a profit, debit side. If there is a loss, credit side. So it is easy for me to keep a tab on plus and minus. Hello, write fast. First you write down year 1. Year 1 is not major action involved. 1/4/16. 1/4/16 to bank. to bank. 10 lakh. March 17, by depreciation 1 lakh. By depreciation 1 lakh is right, 10% rate. By balance carried down 9 lakh. One line blank, write down 1417 debit side. To balance brought down. To balance brought down 9 lakh. Now understand on the screen, follow my instruction. First write down on the credit side, buy bank, sale. What is the sale value? 7 lakh. Now on the debit side, then write down to gain on sale, to profit on sale, to profit on sale. Now how do you compute it? See on the calculator. 7 lakh is my sale value. We are following WDV method. Opening balance is 9 lakh. Half of it has been sold. Means 50% of 9 lakh was the carrying amount. So how much is the profit you are getting? 2,50,000. And then you write 1417 again. To bank in bracket purchase. To bank in bracket purchase 12 lakh. 12 lakh. Is it right? Yes. Now one more challenge before is to provide depreciation. Now depreciation, by depreciation, opening balance of the remaining fixed asset is 4,50,000, right? Opening balance of remaining fixed asset, half is sold, so half is 4,50,000 into 10%, and this new fixed asset 12 lakh purchased in this year at the beginning into 10%. Check the calculation. Is it 1,65,000? By balance carried down. Check the balance carried down. 14,85,000. Now try third year yourself. Let me see who gives me the correct closing balance of the third year. Your chance now. Time over. Who has done? Okay, many students have done. So check. Let the world know your intelligence. To balance brought down 14,85,000. Half mark for this. Buy bank sale value, half mark for this 29 lakh. And then which asset you have sold? This asset which you had purchased in the previous year for 12 lakh, but it has been depreciated by 10%. So sale value is 29 lakh and its opening WDV of assets sold is 12 lakh into 90%, or you can write 12 lakh minus 10%. This way also you can write. So are you getting profit of 18 lakh 20,000? And by depreciation. Now by depreciation we have two assets remaining. This asset A and this asset C which you purchased for 15 lakh. Asset A 50% is remaining and it has been depreciated for 2 years. So I have written 4,50,000, which is the opening balance of the last year minus depreciation 45,000 into 10%. This is the depreciation on the first machine and this is the depreciation on the third machine, 15 lakh into 10%. Have you got 190500? Correct? Correct. Yes. By balance carried down 17,14,500. Got it right. Now we'll continue tomorrow. You will try the remaining part. If you get it right, you will feel happy. Okay. So we'll try in the next lecture.